In Chapter 3, we take a look at some of the journal entries for recording inventory and moving that inventory through the cycle from raw materials into work in process, into finished goods, into cost of goods sold. We also look at a couple of schedules. Schedule of cost of goods sold and schedule of cost of goods manufactured. In this video, we are going to show examples of both. Okay, so in this slide, it goes over the transactions A through H, and then the next slide we will do the journal entries. So here we have A, raw materials were purchased on account for $180,000. B, raw materials used in production. This is going from raw materials into work in process. It's $148,000. Part of it is direct materials, part of it is indirect materials, and they will go to different accounts. C is accrued direct labor cost and indirect labor cost. You separate out direct costs and indirect costs because they go into different accounts that you'll see. Depreciation, then other manufacturing overhead costs. Both of those are going to go into different accounts. Then it says that the company applies manufacturing overhead costs to production using a predetermined overhead rate of $6 per machine hour. So in this example, we do not have to calculate the predetermined overhead rate. It's given to us. It's $6. So for every machine hour used, $6 will be charged to manufacturing overhead. G, jobs costing $495 according to their job cost sheets were completed during April and transferred to finished goods. So in this journal entry, this $495 is sitting in work in process because they worked on it during the month. Now it's completed, so it needs to be taken out of work in process and into finished goods. H, jobs that had cost $450,000 to complete according to their job sheets were shipped to customers. These jobs were sold on account at 30% above cost. So $450,000 were completed and sold. So $450 cost is what we need to record for the sale, the cost of the sale. We also need to calculate the the price that we're going to charge for these items, and we will take the cost plus 30%. Oops. Okay, A, to record purchase of raw materials on credit. This was the very first transaction that I talked about. This is raw materials that we are going to need to work on our product. So it's going to go into the account called raw materials because we have not started into production yet. This is just purchasing the materials to get ready to start. You will debit raw materials inventory and credit accounts payable because it said it was on credit. B, record use of materials in production. Okay, we're going to take some of that $180,000 and actually use it to start the production process. And in B, I had talked about part of it is direct materials, part of it is indirect materials. $130,000 was direct materials. That goes into work in process inventory. The $18,000 of indirect material goes into manufacturing overhead. Anything indirect goes to manufacturing overhead because you cannot directly take that raw material and say it went to this product. Then you will credit the entire amount, both indirect and direct, and credit raw materials because it is leaving raw materials. C, Record wages for the month. In the journal entry C in the previous slide, I talked about how part of it was direct labor, part of it was indirect labor. The direct labor part goes to work in process inventory of $75,000. The indirect part goes to manufacturing overhead of $105,000. Direct labor is the assembly line, the workers who are making the product. The manufacturing overhead portion of the wages is maintenance staff, janitorial staff, supervisor salaries, and the plant manager. That they are over and work with everything, not just one product. So that goes into manufacturing overhead. Then the credit goes to wages payable for the full amount. Next is depreciation. Depreciation is an expense every month or every year, depending on how often you record it. But the depreciation is for all of the plant assets, and the plant assets are being used to produce many different items. So therefore, it can't go to one certain item. You can't say, okay, we're building a table, and this table takes 30 minutes. So we have to take the machine hours used on this machine and then divide it and figure out what it's worth for 30 minutes worth of depreciation. That is too time consuming and not cost effective. So what they do with depreciation is they're just going to take everything and put it into manufacturing overhead. E, to record other manufacturing overhead costs. Other manufacturing overhead costs are going to, of course, go into manufacturing overhead. And we don't know what these costs are. They're just other overhead costs. So just go ahead and take them into accounts payable. You technically could put them into cash, but it's best to put them into accounts payable. F, to record application of overhead. The application of overhead is where we take the $6 per direct labor hour and we multiply it by how many machine hours were used. Because the manufacturing overhead is based on the machine hours, we will debit work in process inventory and credit manufacturing overhead. Okay, now one thing I wanted you to take a look at this point before we do the last one is, do you see that when we are recording overhead costs, we debit manufacturing overhead, and then when we apply overhead, we're crediting manufacturing overhead. This is how you can figure out what your over or under application is. Okay, so I'm going to put a T account up here. Here's a T account of manufacturing overhead. When you record the costs of manufacturing overhead, you're debiting. So the debit of manufacturing overhead is your actual. All of your actual manufacturing overhead costs are debited to manufacturing overhead, as in transaction E. In transaction F, we are applying our overhead. We are applying what we have estimated. That will go on the right-hand side. So your applied overhead is credited to manufacturing overhead. Then at the end of the period, end of the month, you're going to calculate the difference between your actual and your applied, your debits and your credits. And that will tell you what you have over applied or under applied of manufacturing overhead. So in G, we will to record the jobs completed. We completed $495,000 worth of jobs. So we debit finished goods, credit work in process. They're sitting there in work in process while we're making them. Once we finish making the product, we transfer it from work in process, which would be a credit to decrease it, and set it into finished goods, which would be a debit to add to finished goods. H is to record the sales of goods, the sale of goods. Now, if you remember from financial accounting, when you record a sale, it's actually two transactions when you're a manufacturing firm. First, you record the sale. The sale was $585,000. Debit accounts receivable, credit sales. This is to record the sale. And then the cost of goods sold was $450,000. Debit cost of goods sold and credit finished goods. You're crediting finished goods because the item is sold, it's no longer in finished goods, so you want to decrease finished goods by a credit. How you get to the $585,000, that was when you take the cost of $450,000 times 1.3 gives you the $585,000 that they're going to sell it for. If you take $450,000 times 30% or 0.3, you get the portion you need to add to the cost. And then if you add that cost to the $450, you get the $585. You can solve that problem in one step by multiplying $450,000 by 1.3 and get to the answer directly. Okay, let's go through and look at manufacturing overhead and work in process. Specifically, manufacturing overhead. Remember from a few minutes ago, I had said that the debit side, the left-hand side of the T account for manufacturing overhead, is all of the actual overhead that has happened. The credit side is the applied overhead. Now you see that we still have a balance in manufacturing overhead of $5,000. That $5,000 is on the debit side, which means actual overhead is more than applied overhead. So we under applied our overhead by $5,000. Okay. Now, in the second example, we're going to do a schedule of cost of goods manufactured and a schedule of cost of goods sold. The information that they give us is the sales, the direct labor cost, the direct material purchases. And in the schedule of cost of goods manufactured, we're going to take what they had at the beginning, add what they purchased, and then subtract what they had at the end to get what was used. We're going to do that for labor, we're going to do that for materials, and we're going to do that for overhead. So the fact that we have direct labor cost tells us what account that's going to go into. That goes into work in process because anything indirect would go into manufacturing overhead. Then we have raw materials purchase, selling expense, administrative expense. We're also given the manufacturing overhead applied to work in process and the actual manufacturing overhead costs. We already could figure out what we under or over applied right now by taking the difference between $180,000 and $175,050, because the 180 is applied and the 175 is actual. So the difference between those two would be either under or over applied. In this example, applied overhead is more than the actual manufacturing costs. So in this instance, we over applied by the difference. Then we're also given the inventory beginning balances and ending balances for raw materials, work in process, and finished goods. So as I change to the next slide and construct the cost of goods manufactured schedule, the numbers that I'm getting are going to be pulled from this slide right here. Okay, we're going to start with direct materials first, then we'll go on to direct labor. For direct materials, we will take the beginning raw materials inventory, what they started with. Then we will add the purchases, and that will give us the total materials available. Because the goal of this schedule is to figure out what the cost of goods manufactured is. So we have to take the cost of the raw materials we start with, plus the cost of the raw materials we added. Then we're going to subtract the cost of the raw materials still in ending inventory. And that difference between everything available and the ending inventory is what was used. If you take everything that you've had, you subtract the end, what you still have at the end, then that tells you what you don't have anymore. So that's what was taken out of raw materials and used in production. So that is a cost that we're going to be looking at, the 229.5. Okay, then we go into direct labor. They told us that direct labor was 165. And manufacturing overhead applied was 180. If we take the direct materials, direct labor, and overhead applied, we get the total manufacturing costs. Then let's go ahead and look at beginning work in process inventory. So if we take the total manufacturing costs plus the beginning inventory, that tells you what's available. That 574.5 is all of the manufacturing costs that have been put into manufacturing overhead. Not manufacturing overhead, work in process. Then from that number, subtract what you have in ending work in process inventory, and that gives you the cost of goods manufactured. So first, you calculate the total manufacturing costs. After you figure out the total manufacturing costs, you want to figure out how much you had total in cost. Take your beginning work in process inventory and all of your manufacturing costs. Then subtract your ending inventory, and that's going to tell you the costs that have been transferred out, which means those are the ones that have been manufactured and completed and transferred into finished goods inventory. So this is the cost of goods manufactured schedule. Okay, now let's look at the schedule of cost of goods sold. We will take the beginning finished goods inventory of $9,000, which was in the given information, and then we're going to add the cost of goods manufactured that we just finished calculating. That will tell us everything that we had available to sell. Subtract what you still had in finished goods inventory because that is what you have not sold yet. And then this gives you your unadjusted cost of goods sold of $577,750. Now this number here is based on applied overhead, not actual overhead. So what we need to do is we need to make this unadjusted cost of goods sold the adjusted cost of goods sold by allowing for what we under or over applied. Let's take this unadjusted cost of goods sold and subtract what we over applied, which I had calculated for you at the beginning. Now, because we over applied our overhead, we need to subtract it from cost of goods sold. When you over apply, that means you have recorded too much cost. So we need to back some out. We will make manufacturing overhead 0 by the portion that you've under or over applied, and then the other half of the entry is cost of goods sold. Now once you subtract out $4,750 from cost of goods sold, you have your new adjusted amount, your real cost of goods sold of $572,800. Okay, so this is the schedule of cost of goods sold. So this is the end of chapter 3, sample problems.